Welcome back. You're watching Stockwatch with me, Juliette Televi, and joining me to take your stock-related questions this evening are Nick Kunze from Sanlam Private Wealth and Rowan Williams from Nitrogen Fund Managers. If you'd like to send questions, please email stockwatch@bdtv.co.za or via SMS on 41392. Nick is with us in studio. Nick, very nice to have you. A live human body in the flesh, and Rowan is online. Rowan, good to see you there. Nick, I'm going to start with you. So, not exactly a great day on the market today. Prosus and Naspers, however, I suppose saving the day. Do you get a distinct sense of shift in the mood, particularly given what happened to US markets last week and US tech stocks last week ahead of this week's big tech earnings?
Yeah, so good evening, Juliette and Rowan and everyone else. Nice to be in the studio. So, I think that there's certainly we came out the blocks pretty quick in January, had a great January, slided a little bit lower, popped up again, and then last week, a torrid week on the US markets. I mean, we had the chip favourites, Nvidia down 10% and a lot of the darlings, Netflix down 9%. And I think just a reminder that at sometimes valuations count. They came in a little bit light. These stocks are priced to absolute perfection. We're slap bang in the middle of second quarter earnings season. We've got a big week ahead of us this week, so we could see how that sort of plays out. So I think back to your question, I think it's just a reminder that the market's a little bit fragile. And we in South Africa take our guidance, whether we like it or not, from what happens globally. Although saying that was a little bit of welcome relief today. Those Naspers process, that news out of 10 cent this morning gave us a little bit of lift. And as you said in your intro, if it wasn't for that, it would have been another tough day. But yeah, it's difficult to see where we go from here. But as I say, rather than slap bang in the middle of earnings season, so we've got to take guidance from the US.
Rowan, are you worried about the Magnificent Seven, which is now the Fab Four? And I was reading an article by Katie Martin in the Financial Times today, and she said, and a reminder to those who remember the film, 4 of the heroes die by the end of the film. Oh no, 3 of the heroes. Yes, no, 4 of the heroes end up dead. I mean, is it just, as Nick suggests, that a little bit of circumspection returned to the market and everything just got ahead of itself?
Yeah, certainly the sort of latter moves. I mean, obviously there's a lot of demand driving the stock prices, but it's not uniform. For example, Tesla, we're seeing a slowdown in demand in EV. Obviously, chips and AI is still very topical and seems to be strong demands. But I think what's now baked into these share prices is extremely high expectations. So the potential for disappointment is high, and you can see just a read through from SMC to Nvidia is a 10% decline in the Nvidia share price. So I think, yeah, then the stocks are poised for perfection. If you look at the macro indicators from the beginning of the year, we were expecting up to 150 basis points of rate cuts in the US, and now we're down to like 75 or even less. So that is a big change from a macro perspective, and that obviously in the longer duration assets also will play a role. So yeah, we certainly think the markets are going to come off from the highs here, and this is a big week, and I think we can see maybe something of a correction. I mean, you're seeing it in individual stocks, but yeah, I think there is a potential for the stocks to still move lower from these very high and lofty levels.
Sure, that's quite that is quite sobering, considering actually it was almost $1 trillion worth of value was wiped off these shares last week, which also goes to show just how far they'd run, because they're still up year to date, most of them, except for Tesla, which is a really bad year. What about the commodity shares? Nick, there was a question from a viewer who said, excuse me while I pull it up, because they've been all over the place. They've been actually unbelievably volatile, especially the gold and the platinum stocks. I exited Sibanye at 26 Rand 50 and took profit of 13%. It's washed down to 23 Rand 71. No one can figure this commodity cycle. Harmony also took a bath. Which would you enter, if you would enter any at all, indeed?
Yeah, so to the viewer's question, no one can predict this commodity cycle. I think there's some truth in that. It's been such a difficult one to catch. Quite frankly, I think what's been first of all, there's what is the theme for this year? What has it been? What is the story that we in the middle of right now. And Rowan touched on the point with interest rates. They clearly, interest rate cuts were a little bit ahead of themselves. We're never going to get 7 different cuts by the end of the year, and it looks like we might get 1 or 2, to his point. So that's the first story. Secondly, that this dollar's been on absolute charge. This dollar index sitting at 106. I mean, it's just running everything over in its path. So that's negative for commodities. But at some point again, I think these platinum shares were down 50, 60%, and I think Rowan touched on the story of Tesla. They all of a sudden, their sales are down 42% year on year. So, maybe every single person in the world is not going to drive electric vehicles. So maybe platinum has been overdone. So you see them coming back. So pivoting back to the viewer's question, Sibanye is very indebted, so just bear that in mind. It's got a very nice set of sort of a portfolio of different holdings. It's certainly very, new technology focused with lithium and obviously nickel. The gold bars and nickel, etc. So that's the one side of it. Harmony, very much an SA gold play, although they are pivoting a little bit more offshore. I do think that the commodities will come back. We need a weaker dollar, and we might get that. But then we need guidance from what's happening. Once again, I hate saying this, but what do the Americans do? What do the Fed does? We need guidance on a weaker dollar to where we get. So a little bit of a long answer to the viewer's question, but I would definitely be a little bit careful of Sibanye with the debt they've got.
Okay, so you'd be more inclined to into Harmony.
Yeah, but Harmony's problem is Harmony is just more of a gold player. I mean, let's leave both those behind. I prefer Billitson or Anglos, to be honest, if he hasn't got them already.
Rowan, are you also finding yourself wrong-footed or by particularly the gold and the PGM shares? I mean, I don't know if it was last week or 2 weeks ago, we had a viewer saying, have we seen the bottom for PGM shares? And to Nick's point about electric vehicle, the story may have been overdone. The take-up isn't as great as maybe people expected, which favours I suppose, internal combustion engine cars, which is good for platinum guys. So is anyone kind of clear on what the outlook is for any of these companies at the moment?
Yeah, so I mean, they certainly have been whipsawing around. So just when you sort of lose hope and you'll despair, they bounce, massively. But from sort of very bombed out lows, and I think it is on the change of sentiment to the demand for auto catalysts, the demand for platinum palladium, coming off the slowdown of those EV sales. Remember, that was the big story driving platinum initially, so it's sort of a bit of a comeback story. We're not really seeing it so much in the underlying commodity prices, so it's really more a change in sentiment in the medium term. And I think that's a problem. It seems to be that's what's driving the stocks in the short term. It's just sentiment. Are we feeling bullish, or is the market feeling bullish about the prospects for platinum, palladium, rhodium, or bearish? Is there oversupply, or is there going to be a shortage? So what you're seeing is the more sort of clear-headed, level-headed analysts just saying, look for shortages of supply. And then prices will probably firm, and then it's time to enter the stocks. So I would still be cautious here because we haven't seen much of a price response. Only if we see a decline in supply and increase in demand should, I think, get more positive. So I would also be quite cautious. They've got a lot of structural issues, the platinum companies, that they need to wade through, cut some more costs. So in the short term, they're going to be burning cash. And the commodity cycle hasn't turned yet.
And the gold, guys, because there's another question on DRD gold. Would you buy, sell, or hold? Rowan, can I just stick with you, and then Nick, I'll come back to you. Do you like any of the gold shares? I mean, gold prices come off quite a lot, actually, in the last week or so.
Yeah, gold's been amazing. It's been an incredible store of value. It has been sort of in demand with heightened geopolitical tensions. And obviously, the sort of higher for longer narrative also seems to have driven it, notwithstanding that high rates to some extent, negative for a non-yielding asset. So I think it's also run too far, and the gold shares as well. There's I think a reasonable chance of a lowering of sort of intensity of, I guess, the hostilities in the Middle East, and that will reduce some of the risk premium that we're seeing there. And inflation notwithstanding it being a bit sticky will come down. So I think if you've been in gold, it's been a good time, and you could take your profits here, but I certainly wouldn't be entering at these levels.
I mean, Nick, you were similarly averse. I don't know if you have any particularly strong feelings about DRD Gold, because that is also sort of a very marginal player, and actually was the best performer of the gold shares not too long ago.
Yeah, you know, gold is. I'm not a gold bug, but I can understand why people have interested in the current environment. And gold kind of languishes and does nothing for years. Does absolutely nothing. And I'd urge, you know, viewers to look back over 50 years and compare gold to the S&P 500. You know, it doesn't outperform. But what you do get is period of outperformance like now. And you can understand it, as Rowan touched on, geopolitical risks, central bank buying, the Far East central banks have been filling their boots totally on this thing. Besides geopolitical risks, you're getting a little bit of nerves around the US debt, etc. Put that all in the mix, you can understand why it's running. And this is running hard with a strong dollar, as we said. Yeah. But yeah, it does look a little bit ahead of itself, and just be careful being long up at these levels.
Okay. And then a very quick question before the break on Purple Group. The viewer says, I made a small buy into Purple Group because I use easy equities and I hope their Philippines investment works out well. A good punt or not? Nick, do you follow them?
I do follow them. We don't hold them, so disclosure, we don't hold them as a group, but Sanlam is an investor in the business, so bear that in mind. But it's, I think the latest set of results that Mr. Savage and his team put out were very good. You know, the previous to that, we had, we had revenues sort of flat and expenses going up. This time round was the complete opposite. You know, we had revenues going up and expenses down. It might have been that little loyalty, whatever they called it, Thrive, I think it was called, and it's turning out to be okay. But yeah, I think it's a nice run business. It's a little bit small for us as investors, as I said, on the personal private client side. But I think those numbers were very positive in the latest set.
Rowan, do you look at Purple? Do you feel that its share price or its P that its valuations are justified? Certainly, a lot of people said it got way ahead of itself when it broke R3 a share. What was it, 2 years ago?
Peak of COVID.
Yeah. So look, these small cap stocks, they get sort of retail investor excitement, and they sort of can move up in quite a short space of time. I think the underlying fundamentals, and Nick touched on most of it. I think what we are seeing is quite a few of these stocks. Business models are quite exposed to obviously the South African equity market, and if the equity market does well, these companies will do well. There's a number of sort of leverage beta kind of plays in the smaller financial services businesses. So I would probably put Purple in that same grouping. And if we get sort of a positive outcome for the election, it will certainly drive the underlying levers of the business, which should drive performance and, I guess, the share price. So, but it's a bit of a wait and see for now.
Yeah. Okay. I personally own shares in it, and I average down. So I can say to the viewer that I have faith in the company, but don't take my word for it. As the election draws closer, obviously there will be more questions on the election, and two of them are: what do you think the election impact has on sentiment on SA Inc? And a slightly more expanded question: if the ANC does not get their 50%, how does the panel think this will affect the JSE as a whole? And how will it affect pure SA stocks, so SA Inc., versus those with offshore exposure? Should we hold for now, or should we act on this assumption before the 29th of May? Rowan, I'm going to ask you first.
Yeah, so I think obviously the outcome's fairly uncertain. It's, more than likely that what is certain is the ANC will drop below 50%, which means we'll have some form of coalition in order to have a majority. So that is creating a lot of near-term uncertainty. I think although a lot of the negative uncertainty is priced in. So I would say to the viewer to hold local equities. I mean, this month again, they've capitulated further. And I think the outcome, as long as it's not radical, ultimately will be positive for equities, because the uncertainty will be removed. So there's a small probability of I think, a very negative outcome, but a high probability of a positive outcome. So your probability options are skewed to the upside. So probably, given the capitulation this month, it's probably worth accumulating here. I think there's a lot of good businesses. You could take Standard Bank, very low PE. It's down significantly year to date. It has a lot of exposure to Africa as well, and those markets are doing well, a lot of growth. So you're getting that sort of all at a PE of 6. It does look very positive, and there are many other stocks we could rattle on about. So it might be a time to enter, actually.
Nick, do you feel similarly, or would you enter offshore stocks, or as Rowan suggests, that there's too much capitulation and has made them needlessly cheap? SA Inc. shares.
No, I concur. I think, look, it's so difficult. I mean, it's like no one knows. You know, the decent polling we get is on the day, right? None of us have a clue. Yeah. But I do think, and I do concur with Rowan. I think certainly some of the local smaller, medium cap stocks that have come up locally, I think their earnings have been excellent. You know, that is despite everything that's been thrown at them from load shedding and all the, the problems that we have, they've come out with a very good set of results. So, they are certainly, I would say, the risk is not being exposed to them if we get a positive outcome. The rand as well, I think, is unfairly weak. It shouldn't be where it is. It probably should be closer to 16 or so. Just a guess. I'm not an FX trader, but I think a lot of the negativity is priced, and we're waiting. And I'm certainly, what I'm seeing on my side as a private client business and a lot of my offshore investors, no one's doing anything. They're saying, Nick, I'll wait until the 29th. I'll wait till after May. So there's a lot of holding and see. So I would argue, I think I do agree with Rowan. I would say that the risk is maybe not being that exposed, and you miss out if we do get a positive result.
Okay, well, let's talk about some of those mid-cap companies that have done very well, and they are in the travel and tourism business. And the viewer says, everyone talks of Sun International and City Lodge, yet no one mentions SSU being Southern Sun. They have a huge portfolio that is diversified to all market segments. They have a massive Cape Town portfolio that would have had a cracker season. This is true. The underlying fundamentals look great. Why is it ignored? Rowan, do you ignore this one? I mean, certainly... it's true. I have to say, we often just, if we think of travel and tourism stocks, we automatically point to City Lodge or Sun International and then forget about Southern Sun. So what do you think of them?
Yeah, so I think what we're seeing is, and this is a challenge of quite a few of these South African stocks that are sort of valued well and have good dividend yields, there's just not a lot of top line growth. So their forward sort of guidance and number outlook is not that exciting, notwithstanding the sort of strength of the Cape tourism market, and that's why the company's not getting a great rating. So it's just a question of sort of how exciting is the outlook? Is there growth? I mean, the South African consumer is under pressure. We're seeing a spike in fuel prices, uncertainty around load shedding, although that has gone away for the last month or so. So that is an upside from an operating expense number. So it would need closer analysis, but I think if consumer sentiment does improve, you can see these businesses improving. So that's what I'm saying. It's quite, from a market perspective, I think, the outcome of the elections is going to drive some of these stocks higher, and sentiment will improve.
Nick, specifically on Southern Sun, do you think it's unfairly ignored? Sun International has tended to grab more attention.
No, I don't think it's unfairly ignored, but Southern Sun is obviously a little bit more in the local space as opposed to Sun International, and unfortunately, our sort of middle class to upper class consumer has been like literally decimated the last year or two. Interest rates where they are, disposable income, it hasn't been an easy environment to operate in. And I certainly think maybe it is unfair. Maybe we should be looking at it closer. But they are unfortunately a little bit of value traps. They typically not very high beta to the market, therefore meaning they don't normally move when the market moves. So it often falls a little bit under the radar. Again, I think it's just a case of liquidity as well, and I think a lot of overseas investors, or a lot of people who go into the market typically would go for a Sun International or Sorgo Sun or Citigroup just because the liquidity is there for us, whereas a Southern Sun just doesn't have that sort of daily volume as well. I mean, I'm talking technicals here, but that is one of the reasons.
Okay, so maybe to the viewer, maybe that is an advantage, to take advantage of everyone else's ignorance. Sorry, let me find a couple of other questions. Okay, we spoke about Sibanye. Sticking with sort of property-related stocks, the viewer says, I've never heard of Shaftesbury Capital, but I see that the share is trading on a 10% dividend yield, cum div, as of the 24th of April. For the 24th of April. It's come off a price of 48 Rand to 31 Rand today. Do I enter? I have a high risk tolerance for 10% of my portfolio. Nick, do you look at Shaftesbury? It owns the Covent Garden.
Yeah, was the old Liberty spin-off I don't know, there's been so many different name changes.
So there
I
was
can't keep up
Capital
to it.
and Counties.
Capital, yeah, Capcos, and then it became, look, it is prime property. It's Covent Garden, as you said. It's slap-bang London property. Look, I don't follow property too closely, so I'm going to probably pass on this one, unfortunately.
Can I just, okay.
But carry on.
Theoretically, you know, if you were looking at bond yields where they are now and then a property company with a dividend yield of 10%, is it still, would you go for bonds still rather than a property company? Would the dividend yield have to be higher?
So I'd have to sort of throw another one in there, Julieta, is do you want exposure just to the UK, i.e. as in Shaftesbury? I would argue that Europe's probably more attractive than the UK, just a UK play. That's my own personal point of view.
Rowan, do you look at Shaftesbury Capital?
Yeah, I mean, we know the business, and they are sort of trophy assets in the London market. But as a property counter, yeah, we've seen bond yields move up, and I guess that's the reason that the share has come down. The prospective forward yields when you buy at cum are probably reasonably good. It's obviously in hard currency as well, being pounds. I would echo Nick's comments about the UK markets, a bit concerned about growth there and the very high sort of debt to GDP. Also the consumer under a lot of pressure. They've had a very inflationary environment. But these are more defensive assets, so we'd probably need a closer look. It's probably timing-wise a good time to enter now when it is cum, because obviously your entry price is that much lower. So. But yeah, I mean, the rand possibly could strengthen from here, so you need to take that into account as well. So there's quite a few sort of things to consider.
Yeah. Okay. And then what about Bidcorp? The viewer says, does Bidcorp justify its PE of 19 plus? Nick.
So far, yes. They've been delivering earnings. They've been an unbelievable set of results recently, and they just keep on coming out with it. Yeah, at some point, I guess you got to say, look, it's a little bit stretched, but then you need the economy to slow down. But in the environment they're operating in and what they're doing, it's like simple, stupid stuff. It's really is. They've been good numbers, and you know, we hold them, so disclosure there. And I you know, really, I do like the share. I think it's just a great, solid earner. We've held them for years, and continue to hold them.
I mean, they've been kind of weirdly volatile. Rowan, we've got a chart of Bidcorp on the screen, and they've come off their highs quite significantly. Do you think that's justified?
Yeah, so, I mean, the PE now at 19, it was even higher than that, I guess. So, and what you saw in the last set of results was their growth had slowed quite a bit. Because they are an offshore company, they report in rands, and some of the sort of perceived earnings growth is really just currency depreciation from a rand perspective, but it's not a rand business. So
yeah,
the HEPS hasn't been, it's been slowing the growth. So that's, I think, why the PE has moderated somewhat. There were some concerns that slowing food inflation would also squeeze their margins a little bit. That was also driving sort of their top line. So I think the sort of expectations have just moderated to more reasonable levels here. It does look more fair at 19. Again, we was just saying, if the rand strengthens, you know, all these rand hedge stocks, they will come back. So yeah, the rand could be quite volatile in the lead up to the election, but it does feel quite oversold, the rand. So it's just another thing to consider with the offshore investments.
Okay. And then in the last minute and a half, your stock picks, Nick.
Okay, quickly. So COPEX, it's an ETF that trades in NYSE. So rather than copper is sort of kind of the flavour of the month at the moment. Rather than try and figure out like which mining company has the best copper exposure, the easy way out of this is just to do a COPEX. It's a basket of the largest copper miners, trading around about $45. There is $44.82. The more I'm hearing about copper, the more we're understanding that there's a shortage going in, and it's the one sort of commodity that's holding up quite nicely. So there we go.
And for a little flutter, you could have Orion Minerals, which had a spectacular find and was up 31% at one point today. Rowan, how about you?
Yeah, I hope Nick didn't cop out there, but I'm going to go with Exxaro. So there are two commodities that you're getting exposure to. That's coal and iron ore. Both have come off their highs, but they're looking much more solid here. Coal demand remains good. I think what's weighing on the rating, it's come a large dividend. It's still got a massive dividend yield around 19%. They look like they're returning capital to investors, their large cash pile. And I think Transnet freight rail, their performance has been poor, but can improve from here. So I think once that improves, we can see the share re-rate, but you're getting a healthy dividend. It's cum dividend, a lot of downside protection at these levels.
Okay, gents, we'll leave it there. Some old school resources picks. Rowan, thanks very much for joining us on the line, and Nick for coming into studio. Nick Kunze is, of course, from Sanlam Private Wealth. Rowan Williams is from Nitrogen Fund Managers. And up next, The Close. Stay with us.